I'm Ram Shivakumar. I teach economics and strategy at the Booth School of Business at the University of Chicago. Today, my guest is Sarath Naru. Sarath is a venture capitalist. He is a pioneer in venture capital in India. And he's going to be talking to us about his journey as a venture capitalist and about the evolution of venture capital in India over the last 3 decades. So, welcome to the show, Sarath.
Thank you, Ram.
So, Sarath, I actually want to start first by giving you a chance to describe VenturEast.
Sure. I think it'll be good to give context to the audience, your very, very wide audience. VenturEast is an early stage venture capital firm in India, possibly one of the oldest. I would certainly say it's in the single digits, maybe in the top oldest 5. We started back in 2000, before 2000, 95, 97 actually. And we continue to be a VC. We've not changed our stripes. It's a very strange thing for American investors to hear about VC in India, certainly going back to 1995, 97, because where was technology in India? Where is technology now? Now, of course, it's a commonplace, the word about technology and AI and what have you in India. It's accepted. But back then, it was not technology. It was something else. So VenturEast does that. We are into our 6th fund now. We continue to, and I'm looking at transitioning into my next role in life. Of course, while I transition out of VenturEast, my goal, and we'll talk about that later, I hope, would be to see what would be the transformative journey that VenturEast would have going forward.
Sarath, I think we're going to get a chance to talk more about the specifics of what you do at VenturEast. Tell us a little bit about your education in India and outside of India and the early part of your career. In particular, I'm interested in pivotal moments in those years, experience you had that put you on this path.
That's a good thing for me to answer, self-promotion, but I hope that's not what it is. But I see 2 distinct things in my life that got me here, what I'm doing. One part is essentially that I grew up in a rural background till I was 10, then moved into an urban background in Hyderabad. Went to a school which had a huge number of leaders come out, Hyderabad Public School. I was not one of them, by the way. I don't count myself as one of them, but certainly that was the experience. Then went to IIT Madras, and then when I studied engineering, I went after a couple of years of working as a management trainee in a cigarette company, subsidiary of BAT, went to Chicago to do an MBA in finance and accounting. You might ask me, I had a few other options, but I chose Chicago because I thought finance is where the power structure of a company lay. And of course, that was disabused or later. And every company has its own DNA and who actually leads that particular business. And so that's one phase of how what I did. And after my MBA in finance, engineering, manufacturing, finance, then I went and worked for Procter & Gamble in brand management in the US, in Cincinnati. And then I went into another part of my journey, which I call as an entrepreneurial approach, where it was all about using my brains and brawn, if you will, and other people's money. And the way to start a business in those days, back in the 90s, venture capital was still, or late 80s, venture capital was still not a very popular term, and I had no clue about it. But the point was, I got into what one could call as trading, which was trading in engineering goods, finding buyers in the US and finding vendors in India. And that was a business that I set up. And then it was fairly successful, allowed me to have enough of a lifestyle of income to go back to India. And when I went back to India, I was looking for another line. And again, the whole thesis was the same thing, which is required less of my money, more of my brains and brawn. And where the big boys weren't really were the big competitors. You did not want to compete with the big boys. And that was what venture capital, that was how the whole thing started. So the first phase was mucking around with different things to do in life. And the second phase was still mucking around, if you will, but I was looking for a career and an opportunity where it needed less of my capital, more of OPM or other people's money and my brain and brawn. And that's how I got into the idea of venture capital.
That's interesting. And I know that your first venture fund, your foray into the venture investing business, began
Yeah.
when you helped privatize the Andhra Pradesh government's venture arm. How did that happen?
Ram, I go back to the talk you gave, last September and October beginning, where you said life is what happens to you, and that's what is the most important thing, and then how you deal with those things, those lives. How should I put it? What life gives you as an opportunity, and it's not really that you had a very studied approach to solving a problem and building your career, and that's the way it went. It was not. I mean, that's why I said throughout there was only a broad phrase. I was mucking around, and the same thing I was mucking around with the how to get into VC in my third phase, and it was purely opportunistic. It was not a thing that I said, okay, this is because the ability to go and privatize APIDC Venture Capital Fund, which was a government managed fund. There were only 5 government managed funds in India, maybe a couple of private sector funds. Totally opportunistic because I was looking to start a fund without having a clue on how I was going to raise money. I put together a team. And I went and met the World Bank saying, "Hey, I'm looking to raise a fund. Will you guys give me money?" And they said, "Listen, we give money to the government, not to the private sector." But they said, and I went all the way to Washington DC because I'd moved back to India by then. And they said, however, there is a government-run fund which is being privatized, and you should bid for it. And that's how the journey started. Of course, there's another journey about how we privatized it, how we won the bid. But it was not a studied approach. It was one of those things that notionally there was some idea of venture capital, but why was APIDC VCL or VCF was the right way to go bid for it, etc., was purely chance.
So here you are now. You are acquiring the Andhra Pradesh government's venture fund. I take it that they wanted to privatize it because they probably believed that they didn't have the skills to run it. Is that correct?
You're absolutely right. And that's what the World Bank team also felt. They didn't have the skills to run it. They said, and the government bought the idea, and they said, okay. And that's what happened, yeah.
So now you start running this fund, and there are 2 things that I think of. One, you had to actually acquire it, you had to bid for it, so you had to raise some money. What was your pitch to prospective investors? Right. I'm also interested in learning what kinds of companies you are going to be looking at.
So I think, one of the things I'm reasonably proud of in my journey, as I mucked around, was what was the pitch to the investment committee which was going to privatize the APIDC Venture Capital Fund or Venture Capital Limited. My pitch was, one, of course, we were very prepared. In terms of showing deal flow, we had the backgrounds to find the right kind of investments which were going to be globally competitive, because in those days, India had just started privatizing, liberalizing, opening up the borders, deregulation. So you needed to build businesses which were going to be globally competitive. So I said, we are having worked abroad, studied abroad and worked in India, studied in India. We are best suited. I put together this team. And while that was fine, it was really our understanding, again, totally textbook, Ram, I should tell you this, because I had no clue on venture capital other than the fact that it needed little of our money.
Yes.
The thing that we learned and we studied, and there was one book I remember, Venture Capital at the Crossroads. It's maybe not in print anymore. This is around the 90s. It was just new print, late 90s or mid 90s. It showed that venture capital funds, 80% plus, 85% are run by owner-manager driven teams. And maybe about 5% is corporates and another 5% is banks and financial institutions. I'm not talking about private equity, I'm talking about venture capital funds.
Yeah.
And my pitch to the investment committee, after giving our credentials and showing how well prepared we were, etc., was that, hey, you want to privatize this because the skills and the DNA of an outfit that would run this has to be owner-manager driven. with our kind of DNA.
Yeah.
Not going back to our four competitors who were, by the way, CRISIL, which was the subsidiary of ICICI, Mahindra is a large auto major,
Yes.
Videocon was a large white goods major, etc. So that was a major pitch to just to that particular bit, and that worked. They said, "Hey, great, you think you can run this?" They bought the story, but they said, "Hey, can you raise capital now?" And now got to the next story of because the fund manager is not just deploying capital; you need to raise capital. In that story, when we met investors, and then we met a number of institutional investors, we met, of course, HNIs in the US. These were not high net worth individuals alone, but they were high net worth Indians
Yeah.
in the US.
Yeah.
And the story we gave, and I think it's an interesting story from the perspective, because venture capital still was new even in the US, according to me, late in the 90s, was that the investing in VC is about where there's a disruption in the industry. Typically, we keep assuming it's technology disruption.
Yeah.
Yes, it is some science disruption, but it is, at least in countries which were just emerging, such as India, it was about regulatory disruption, where disruption was happening because of government deregulating in specific sectors. So we went in there and took over created a business as an existing business or a new business, start a new company, which would leverage and take advantage of the deregulation better than the incumbent was. And that played out actually in our first fund. Our first fund, we went into pharma sector because pricing was being deregulated. We've now got a multi-billion-dollar company which is listed. We went into the dairy sector because, again, milk could be procured and large private sector dairies were being allowed, other than just going to the Amuls and the state level dairy companies. So we built, a dairy company that is again listed. It's close to $1 billion in market cap.
Yeah.
And we went into ports, for managing seaports, which was now the largest port management company in India and in Asia. They manage ports and got acquired by Adani recently.
Okay.
And then, not that we didn't do tech, but we felt it was not the time for .com in India, though .com was, really flying high all over the world. So we did do one of the first fabless semi-conductor plays in India. And we succeeded, managed to list it in India, made good money, etc. So to answer your storyline, there was this pitch of ours how to raise capital first, and then the second pitch to a second set of investors, and then how the investment thesis did play out to our with a little bit of luck. There were very few people like us offering capital to early stage companies, and all that helped.
Sarath, that's a nice overview of both the fundraising dimension of being a venture capital and the deploying of the money. I want to go backwards because I imagine 25 years ago or so when you started that the investment opportunities for a venture fund were far more limited. And I imagine that many smaller firms, or call them family-owned businesses, may not have been very familiar with venture capital, the role of the venture capitalist, and may have even been fearful about taking money from venture capitalists. Tell us a little bit about that experience, because that surely had an impact on the companies you ultimately invested in.
That's you bring out a very important point. The nature of the entrepreneurs that we backed, that's been the biggest change, Ram, from what it was to what it is now. And the thing is, the entrepreneurs in India in those days, and I'm not talking about the tech entrepreneurs. There was a tendency to believe if they were already started and or it's a scion of a large family coming out to start his own company, there was a strong feeling of entitlement that we know what to do, we know how to do, and we don't want to, we'll take your money and then just stay out. And that approach was there, and that made us, of course, fearful of working with such entrepreneurs, simply because not that we were experts as a fund manager, and we were also learning a lot of these things along the way, but it was more about, that you can't have a healthy discussion at the board level. And it is, there is this famous phrase amongst the VCs: is the entrepreneur coachable or not? And it's said not in a presumptuous way, but in a nice way that, hey, you want to be able to have a healthy discussion on the pros and cons. And typically we will always support the entrepreneur. Finally, if it comes to the point where you say it's a judgment call, enough data has been thrown, my judgment is this, then we'll go with the entrepreneur. But then that ability to have these discussions and so on was certainly not a very common thing, and that had to be something we had to address. We've had some. Anyway, to answer your question, that was challenging. The kind of deal flow was challenging. Even if you got the deals, then the kind of entrepreneurs were again even more challenging. So it get tough to deploy capital.
So, Sarath, in those days, what was exit like?
The biggest change, I think, then to now, I shouldn't say the most important change, and the change that happened the last, is the ability to exit or monetize your investment.
Yes.
It has happened only in the last 5 years, Ram. Until now, while Indian VC scenario has changed dramatically in terms of the number of entrepreneurs, the nature of the entrepreneur, the types of businesses, you probably will not see a difference between a tech business in India versus a tech business in the US. All this has changed. But the last thing to change, and the number of investors and co-investors, VC funds, intermediaries, consultants, advisors, all these things have changed. But the last thing to change, which was just happened in the last 5 years, is the ability to monetize your company and create an exit. Public markets are offering many opportunities. Now to list there, more large funds are there, large private equity funds which are tech focused, and they want to acquire a stake of the VC. That's opened up dramatically. And strategics, while Indian strategics are there, they might not pay the best price, but there are a whole lot of strategics who are there in India as well. Right? All these didn't exist then. We went in with the hope that while we did have a reasonable number of IPOs, 10% of the fund do IPOs, you're great. I think that was maximum you could expect. Like out of 20 companies, or maybe 3 sometimes. But now the proportion is a lot more. That's what we went with, maybe 10% in IPOs, and another, there's something called a promoter buyback or the founder buyback. So basically, it's the founders come from a large business family, and you obviously didn't get the best price, but he would buy you out, or find another buyer to buy you out. So we had limited, and then anything you sold to another fund again was not a great outcome. He made a return, but maybe better than what the promoter buyback was, but you didn't make a return. But so it was very limited in those days. And it took much longer to create those exits. And that's a big, by the way, storm going on in India in the VC investment scenario, because the SEBI is regulating and saying that you cannot extend the fund life of a fund, even though you have good investments there and they need longer to exit, and your investors, the LPs, are okay with it, but SEBI is saying no. That's a separate story. But just to tell you, we had limited exits then for all these reasons, but now there's a lot more now.
How do you think about the role of a venture capitalist in adding value? What is it that you've discovered over 25 plus years on how a company like yours adds value?
No, it's this has again gone a metamorphosis of some level, I should say. This whole thing about adding value. This is what we found, right? We also started with this whole idea that our role is to add value to these portfolio companies, and then we force ourselves on the entrepreneur into areas we have very little business or experience to be forcing ourselves on. And that started happening. And you also start getting full of yourself, or assuming that you can add value sitting on the board and pontificate, and that's a dangerous thing to happen. So we've gone through in India in a time frame when, as you pointed out, there were not too many VC funds, and capital was at a premium, and you could participate in these companies without having to say, "Hey, what value am I adding beyond capital?" And you could look at governance, you could look at areas outside of the company itself. These are nowadays it's commonplace to do. You make introductions to clients, introductions to investors, introductions to key people, those kind and governance, of course, you kind of in there. And there is at some level you also start. Those are commonplace. We should do that. But thinking we know their business better than them is a dramatically wrong thing to do. Then why the hell did you? I mean, you could have started your own company. So you why back this entrepreneur? You made a bad choice then. So that's an important thing to remember. It's possible that Vinod is probably, I met him once in India and we had a chat because we had started one of the first life sciences fund in India, and he wanted to meet me, and then we had this chat, and then but he's an operator investor.
Yes,
I mean he's not simply an investor, and that's a different kind of investor. Right. And there are smart entrepreneurs who are also looking for advice beyond, at strategic, at a holistic level. You draw parallels from other industries and apply it here, those kinds of approaches, not necessarily telling them how to build their direct business, direct operations. So I think that's what we are. I mean, there are specialist funds in India as well who would say, we want to be able to help you at the operational level. And that there's a role for that. There's no doubt about it. But I think most of us, as VenturEast at least, we've become very cognizant about recognizing the entrepreneur, building the relationship with them, recognizing also that our value add is outside of what, external to the company as opposed to internal to the company. And it's very important to India, by the way. That's another important. That's our next evolution of our own VenturEast philosophy and next model is about how do you enable this entrepreneur to feel stronger, become stronger as an individual? Because India, the entrepreneurial system, much tougher than in the US or in China.
Yes.
Even going into Europe. And because the challenges are many, scaling a business is much, much tougher. So they need support that they need, all the support that they need it. And our approach is to say, how do you help this person go through challenges and not be pontificating to them? The same time, once you get them on your side, then of course you can do other things with them.
I want to now pivot to the entrepreneurs. You've spoken a little bit about the venture capitalists, and I've read a little bit about them in Indian magazines. But how has the entrepreneur itself changed over the last 25 years? What are you seeing today?
Okay, one thing is we have a whole lot more entrepreneurs than ever before. This is a buzz, and that's great. The country needs it. And of course, there are entrepreneurs who deserve to be an entrepreneur, who can handle the risk, and there are those that cannot. And eventually they'll sort themselves out, which is fine. But I think the most, some curious things are happening. And this is happening also because we've also reached a stage where there's a lot more money available, particularly in the early stages, and then maybe not in the middle stages, but again in the higher large deal stages. In the middle, there seems to be kind of a little bit of a vacuum.
Okay.
And then when you have this situation when there's money chasing the entrepreneur, that overall level of entitlement goes up. And I already made the point that it's very tough to scale business in India. And you as an investor start pandering to the entrepreneur. And start changing their behavior. And I think you read enough about misinformation or manipulated information in Indian VC companies. Some of the poster childs of India, whether it's Baiju or Go Mechanic, and they were the best of VCs on their cap table. And it was not like a small venture fund that had invested, but the best guys. but still everybody is pandering to the poster childs, and they treat them with kid gloves. So governance took a backseat, and so on. So the entrepreneur, that's one phenomenon that's changing at some set of entrepreneurs, where the entitlement is then leading them to behave in a way which is not full of governance. And there is also money that it was one of the axioms in our investing in the old days was the entrepreneur does not exit before you exit. Now the entrepreneur is a multi-millionaire well before the VC has seen 1 cent coming back from their investment. Now it's very commonplace. We allow them to do that. And then they start becoming investors themselves. And they are becoming early stage, seed stage investors. So that's the change that's happening to one set of the entrepreneurs. But I think the VC tribe is also beginning to realize that you have to stick to your knitting. Let the entrepreneur build the business and not say, I'm going to build other businesses. I'm going to be the God sitting in judgment on who's going to be getting a little bit of money from me. So that's been the change. But I think we will swing back. The pendulum will swing back again. And we'll have conservative behavior from the entrepreneurs as well.
I want to go back to probably for me one of the most difficult questions in investing. How do you decide whom to invest in?
It's a very good question on this, Rob. Simply because I'm just going to say this out aloud because they say that in real estate that the 3 primary requirement conditions for a great investment is location. And VCs have copied it, and we say it's the founder. But I don't believe that we actually practice it. Because it's not because we don't want to, because I think it's difficult to evaluate that. And the biggest challenges for us has been misreading the entrepreneur. It's not about misreading the business and the business opportunity, and are we timing it right, etc. Whether you time it right or wrong, if you got the great entrepreneur, he will pivot or she will pivot. They will do what it needs to make it successful. And we know that. But having said that, do we have the toolkit to actually make that assessment is the biggest question.
I wonder whether, Sarath, I actually wonder whether even the entrepreneurs know. I guess what you are also saying or raising as a question is whether it's actually possible to know it all. I mean, people may become great entrepreneurs. They may not be so in the beginning. So as an investor, it's hard to know. I wonder, Sarath, how much integrity and character matters in this whole thing. Of course, you want capability and intelligence. But do you think it's actually possible to read integrity and character more accurately?
We kind of we have integrity as a key pillar of our assessment of the entrepreneur.
Yes.
And then we have the easier part, which is relevant experience. And then we have character, which is combination of we say drive. Grit is another word that's used, but the ability to stick through it and not give up, and the ambition to achieve high goals, etc. That's the third bit, which is what we're calling character, I think. I think that's, as you said, maybe most of these entrepreneurs are not really, only will become entrepreneurs, as you correctly said.
Yes.
They'll be in that situation. But I think integrity is a lot more easier to assess. And I want to tell you this, I'll come back to the story, whether I don't know if that's about integrity or what it was, but that I think we talk to people around them, we do a 360-degree view of their entrepreneur, their employees, their colleague, cohorts, their bosses, their bankers, their family members. We kind of do a surreptitious kind of view profile. We try to, I should say that, right?
Yeah.
But then we also, I think we need to get more disciplined about it. We've tried, and I think every time we need to, if there is so much demand for that particular company, investing in that company, you kind of say, hey, let's take a chance. Everybody else is putting in money.
I understand.
I think, so we're still I think you've said what the challenge I think we are facing. You already summarized it well. Not mucking around. We say that's the most important thing to evaluate.
Let me actually now turn to the rights and wrongs. Memorable investments for you, for both good and bad reasons. Anything you want to discuss?
Yeah, I think the ones that I particularly enjoy and I think they're memorable are the ones that went through a hugely tough time and had to pivot and many things to become successful. And otherwise, you're on a great track. You keep getting funding, and you had a little bit of luck, and the market also plays along with you. I mean, that's an easy story. So I have one story which I particularly like is a company called Kissht, which is possibly among the top 3 consumer fintech companies in India. Consumer online and otherwise. Kissht means installment. But this company was not always Kissht. It was actually part of our thesis going back to many years before that, where we were looking at the Indian semi-urban and rural market who were not internet savvy, but they were still buying. They wanted to buy things that the people on the internet could buy. And we said the way to do it is mail order. They would get mailers from banks with their credit card statements in the semi-urban areas. And we found that financing was becoming a big thing there. 95% of those people who bought in the semi-urban rural used financing by the bank. So that said, we spin off this finance part of it. And then we built out this company. We found a team from McKinsey who had done a stuff, doing a finance, fintech startup, broadly in the same area. We put that together. The parent company died, but this, we managed to pull this together, and we started getting good investors one after the other. And now they're, there will be a unicorn for sure, but right now they're a soonicon. Again, it's very, of course, it took us 14 years plus to get to this stage, but the point is, it's good to, we feel good about having helped something happen, very interesting happen. The founder also was very, very happy, though he lost money in the parent company, but he made. So that's the kind of stories we like. We have a number of other companies which are done very well. They just kept growing, got listed, they're multi-billion, but I think these are the kind of the smaller stories which we like.
Sarath, now we go on to what I call the rapid fire round. Always start with rapid fire round.
Okay, lovely.
I've got a bunch of questions for you, so that I can give things that are revealing about you as a person, your tastes, your preferences, your loyalties, and so on. So I'm going to start question number 1 with influence. IIT Madras or the Booth School of Business?
To be very candid, that's a tough call. But IIT Madras, I have to say, Booth came a very close second. IIT Madras simply because it opened me up suddenly from being in school, going into an area where there were, few things protecting us. We're in a wide open world. Kids came from all over India. But by the time we went to Booth, we kind of used to that kind of situation. But IIT Madras was a great influence for me.
Super Kings or Royal Challengers?
Super Kings for sure. My wife would kill me if I said Royal Challengers, despite me being in Bangalore. Super King, not just because they've been the winningest team, but there's a lot of loyalty, right? For Chennai.
For being a Chennai boy. Now let me get on to sport. I'm going to ask you a tennis question. Nadal or Federer?
Okay, I'm a Federer guy. So is my mother-in-law, by the way. She's 88 and she still plays tennis. I mean, more in the old style of classical, gentlemanly kind of game.
Volley?
Yeah, sorry? Yeah.
Serve and volley?
Serve and volley, and you unruffled. It's a gentleman's game kind of an approach. not too much histrionics. Not that Nadal is. I love Nadal, but yeah, Federer, absolutely.
Let me now turn to question number 4.
Yeah.
Preferred holiday destination, Hawaii or Coorg?
Oh, that's easy for me. Coorg. I'm not a beach guy. I love Coorg. I love the hilly areas, cooler areas.
What do you do there?
I spend a lot of time on the balcony, whether it's work or eating meals or having, as you said, a drink at the sunset. At the same time, there's golf there. It's about 34 minutes away, the golf club. You can also practice a little bit of cooking. I've built a chef's table where I hope to be cooking and invite friends to watch me cook. I've had to yet to do that though. But things, and there's it's a tropical rainforest area with coffee and pepper and all that stuff.
That's
lovely people as well.
Yes. I thought so. Akhil told me that you have a partiality towards Coorg. Well, my last question for you, Sarath. Your idea of a romantic evening with Meena. Dinner at a restaurant or evening at home and a walk around the neighborhood?
I think that's an easy one. Dinner at a restaurant, but I would like to gravitate towards dinner where I make the dinner. Right? I used to I love to cook, but I haven't been cooking for a long time. I want to get back into it, and then I'm sure Meena would. And Meena is a great dessert maker, but she doesn't cook otherwise. So.
Well, Sarath, thank you for spending an hour with me today and with sharing with me and all of us your model for venture investing. What I've always thought about you, and I've known you for some 20 plus years, is that you have an enormous amount of tacit knowledge and that you're very quick in assessing things, circumstances and people. I believe this is a rare talent, but this is one that you've honed over the years. Another thing that's also clear is that you're very well networked. You have a very good sense of how to put a deal together, how to make things happen. This is an underappreciated skill because in almost building any business or in venture investing, you need to know people, to bring people together to complete things, because it is unlikely that a single person can do it on his or her own. And so you have these rare qualities. And I believe that someone like you will be enormously valuable socially, even beyond this 5-year period when you may formally check out of VenturEast because of exactly this, your ability to make a judgment. So I think we should all be very grateful for the things that you have done and the things that you are doing. So thank you so much, Sarath, for sharing all of this with us. And I want to wish you the very best.